So the topic here for the balance of the presentation is to talk about this copyrighted, Scott-compliant, non-grantor, irrevocable, discretionary, complex trust with a simple provision. And there's no one better here that can really help us learn about this trust than Rob West. Over 47 years of high-level experience as a CFP, registered investment advisor, financial plan writer, investment broker, Wall Street VP, insurance advisor, and estate planning paralegal. And so Rob has taken out his time. He's from Colorado this morning. I think that's only 1 hour earlier than us here, the East Coast. And we're going to ask Rob to say hello, and we'll begin the presentation, and we hope that you all see something that opens your eyes here. Good morning, Rob.
Thanks, Al. Hey, good morning. Good morning.
Don't be afraid to speak up.
Okay, yeah. I hope maybe this is coming through a little
bit better. Take it away, Rob. It's all yours.
Okay. Can you hear me good, Sal? Sal, can you hear me?
I believe most can. Yes.
Great. Okay. Well, thanks for listening in today, folks. Sal, I appreciate the invitation. And the main question is, what's this information today? Why is it might be important for us, or for you individually here? It's because this individual trust itself, very unique. It's a game changer for a lot of people in terms of not only their lifestyle, but their business, their taxation, and how they handle their estates and so forth. So just really happy to work with that. How can we make things better? I don't know. I'm assuming, Sal, most people here are entrepreneurs, maybe in their dream job, looking for a dream client, but how can we make it better? And I think as we go through this, we'll see an estimated over 30,000 taxpayers have already demonstrated the usefulness of this, but you wouldn't know about it. One of the reasons is most of the time you need to be invited in some way or form to know that it's available, but it is pretty awesome. So what does all this mean? Sal, let's go to slide 6. You mentioned the copyright Scott-compliant, non-grantor, irrevocable, discretionary, complex trust with a simple provision. All those elements are in this trust document, but here's what it means to you. It means that legally and meaningfully you can separate your assets and your income away from your personal self, from your corporate veil. You can defer income taxes indefinitely. You'll be able to shield assets from creditors and predators. You'll negate capital gains and the associated taxes involved with 1031 exchanges. Those types of transactions are not necessary for trust property. They eliminate probate and death taxes, as Sal mentioned, because it is an irrevocable trust. Interestingly, in the professional sports arena, particularly the NFL, these trusts are used and they're like because of marital property disputes are not an issue because there is no marital property involved within the trust assets themselves. And you can convert most of your living expenses and your transportation expenses to be provided through the trust income and expense mechanisms, filing a 1041 tax return. And there's other things too. So next slide, if you would, Sal. You may have heard this before, but Nelson Rockefeller is credited with saying the secret to success is to own nothing but to control everything. And this is what this trust provision does. So what is a trust? There's all kinds of terms associated with a trust. Revocable, irrevocable, who's the grantor? Some people are not familiar with being a non-grantor trust. There's various specialty provisions and clauses that can be put into a trust. The trust document itself is what sets the terms and conditions of how the trust operates. Trust law is very strong. It's been around for hundreds of years. Originally, the trustee was a chosen friend that would do things to protect property for the benefit of a family when the father would not be around. Obviously, the family members would be a beneficiary, but as we moved into the United States, and since we were formed, all kinds of taxes and other things get in the way, including probate. But what we do is, why would you want to consider a trust? Why not an LLC, or why not a corporation? Well, if we take some time, we would say, why not both? And I will share with you how to move and integrate a trust in with your other business entities. So what I said earlier is somewhat unbelievable, and the reason I want you to just note briefly what a copyright is, it's not, a copyright's very much investigated, and you cannot copyright something that's not legal. After the copyright is written, it'll last in terms of law for the next 70 years after the death of the last author. This trust was started in the mid-50s by a Harvard law professor. In 1999, it was originally copywritten. It received another copyright update in 2012, at which time Internal Revenue Code 643 was incorporated into the trust document. So, next slide, Sal. So, this one is copywritten because it's a very unique process and origin, because you can't copyright the law, but the law is used within this. There's various things you would be familiar with in terms of a trust. A settler who makes the trust, settles it, puts it into being. If you're familiar with what a shelf company is, if you organize a shelf company, you'd be a settler in the trust world. Grantor is usually one who grants it into being. It's usually the one that places property in the care of the trust, and the trustee is the person or persons or corporations that actually controls the trust property. And beneficiaries, obviously, the person benefits from the provisions of the trust. But what we've done is we've added a compliance overseer. And this compliance overseer is the unique part of setting this trust up. And the compliance overseer has a very interesting part in the life of this trust, and he can assign the trustees. He can remove and replace trustees. He can also be a trustee himself. But as we go through this, the copyright and the use of the compliance overseer is the uniqueness that gives asset protection and other provisions that you don't find commonly in other trusts. So, real estate, I know Sal mentioned some folks are in real estate. In Section 643 of the Internal Revenue Code and other sections, primarily 643, you'll find that there's no recognition of a capital gain. Therefore, there is no capital gain taxes, no need for a 1031 exchange. I have a client in Texas who does cost segregation accounting, and if you're not familiar with the cost seg structure, you can reestablish your taxation picture and put money into your pocket by accelerating depreciation on various items. And what he does is he puts those cost seg things in place, gets cash refunds, and a big reason why not to do cost seg, maybe you don't want any recapture of the tax in the future years if you sell the property. And so what he does the cost seg, puts money in your pocket, establishes a trust, puts the properties into the trust, and then he's free to sell away at any time because the trust has no recognition of capital gain. The estate values are obvious. If they're not included in an estate of a human being, there's no human ownership that takes control of your property, whether it's death, incompetency, some disability. So it's a huge asset protection mechanism. It also qualifies for immediate Medicaid spend down. And there's many other uses in this too, but real estate is very popular as well as a few other industries that find this very useful. I mentioned earlier there's no divorce disputes because we've eliminated any marital property. The trust owns the property. It's not part of the marital property ownership. And that's also the same reason where there's supreme asset protection from creditor liens and court turnover orders and so forth, because the assets in trust are not the ones, not the assets that create problems. They're protected. Interestingly enough, one of the major banks we work with has been doing trusts for so long, we recommend the use of that bank. It's because there's no paper trails with them, and they actually keep no records of the account opening, just in case an investigator or an IRS agent would want to be doing some investigation, goes into the bank and wants to have some interest in different accounts. There won't be any accounts to be found there. Perfectly legal. It's just another part of asset protection that our accountants and enrolled agents and lawyers help you with the process of maintaining your financial privacy. So, what do we have next, Sal? You're always in control. So many people are concerned about the irrevocable nature of the trust, and everything should be entered into with complete knowledge, but the trustee can terminate the trust, and these trusts are set up for a period of 21 years. It's much like owning an IRA account for 21 years and then renewing it and then renewing it, and then whoever the trustee at the time is can renew these things every 21 years, therefore maintaining the no probatable items, the no taxation items, no inheritance items, and this has been done by the wealthy people for a long, long time. You just probably have not heard about it, but the trustee is always in control, and don't be concerned or afraid about the irrevocable nature. So there's specializations that we're working on to use these trusts. They're very popular in the oil and gas industry, particularly in Texas and some other parts of the country. Real estate we've covered just a teeny bit about. There's a specialty version coming in towards retirement. Charitable endeavors and beneficiary endeavors, and there's various levels of business integration with this type of trust. And it's interesting to note that Netflix, for instance, and Amazon do not pay federal income taxes, and they do that legally. Not sure exactly if they have this, but they're more than likely running under 643 of the Internal Revenue Code perfectly legally, and they're probably, I don't know who they bought their information from or who put it in place for them, but it's definitely out there, and you probably run across it. You just are not familiar with it. So what do we have next, Sal? How can you benefit from this? Well, personally, for yourself, for your business, depending on your income and tax situations, you might be able to benefit because of the tax benefits, the asset protection yourself, generational transfers. If you're in the insurance business, for instance, down at the bottom, we have some people using this because one of the benefits of a Spendthrift trust is to grow the assets inside the trust for the benefit of the beneficiaries, and one of the best ways to do that is to insure the trustees. And we see a lot of life insurance being written. Medical practitioners enjoy this for sure because of their liability within their practice. I have some young lawyers and older lawyer friends, and I tell them, if you're an older lawyer, you can incorporate this practice and use these benefits yourself. Maintain your practice. If you're a young lawyer, you can use these same principles and probably advance your law practice significantly, knowing that some of the things you were taught to do in law school won't be necessary anymore if you help people run the trust. So you can dominate an industry with this, and the client benefits, if you're in one of these particular industries that have clientele and you're building your business and you're looking for referrals and so forth, people love people who give them money, and you could be one of these people that would know some things about this. You're good with me.
Okay, great. So here's the question, Rob. All this sounds terrific, that this complex is pretty complex, but yet it doesn't need to be. We need to know who is the right target person that this would fit. It's great. It's for a company. It's for a business. It's for, professionals, entrepreneurs, athletes, that's great. But when we run across someone, how do we open a discussion with them that leads to this area? What are some of those key phrases that can be used when we're speaking to someone that would open their eyes, turn on a light bulb, and be able to now engage with them at a deeper level so that we can now grab them as someone who, sees us as a real true professional?
Good point, South. Some of the folks in the family office network arena, one of the main things that is of concern for them, for those people who have considerable means and tax liabilities, and that is their primary thing is they're afraid of losing what they already have. They're not really risk takers so much anymore, and they just want to maintain and keep the control maybe within the family and pass it along. Another thing, just within general business, if you run across someone that has a significant tax liability, there's an awful lot of limited liability companies, and at the end of the day, after the expensing, there's a K-1 that goes to the owners and it passes through the taxable income. And there's ways to integrate this trust to take your place to accept the income. And then what happens as a trustee then, you put on a different hat from the CEO to be the trustee. You can declare that income to be an extraordinary dividend, which is defined under that 643B. When you declare an extraordinary dividend, you're saying you're going to keep it in the trust, and therefore you can elect to defer the tax. So we've taken situations and reduced the tax liability off the 1040 return to like at least a 90% savings in federal taxes. And the IRS says it's okay to have that in 1043 as long as there's a possibility for a tax, just like with an IRA. But instead of having the age 70 and a half rule, these are set up to run for 21 years, and then they can be renewed and renewed and renewed.
That's phenomenal.
That was a good question.
So. That is, yep. And so you spoke earlier about establishing shelf companies. Maybe you can just speak a little bit more about what that really means.
Sure. I have some private international bank experience, and some folks in one of the islands I was working with is a law firm out of London, and what they did was set up international business companies and keep them active until someone wanted to buy them. And so you might have a need for a company that has been seasoned for maybe 9 years, and you could go to them and buy that company, and that company sits on the shelf until somebody uses it. It's the same principle for us to use a compliance overseer to set the trust up. And it could literally sit there for 9 years, and then it could be sold to someone. And what we do is we connect them with buying the copyright to use this process. And let's say instead of the shelf company, it's a shelf trust. It's set for 9 years. You're now using it. And when you become the trustee, you put your assets in there. And the reason that step is very important is that there's no alter ego association of you starting the trust and you putting your assets in. There's where the asset protection comes in. And so the shelf company, the trust with a compliance overseer, same principle.
Does
that make
this
sense?
Substitute now? Yes. Does this trust here substitute the reason or the need for people to move their money overseas as they used to do in great numbers?
Well, the asset protection nature of it is probably superior than than the overseas transfers and that kind of thing. I've done both. I have a lot of knowledge about that, but this day and age with electronics and control of things, if you are working within this trust mechanism and you simply want to protect and have available your accounts, I would prefer looking at your alternative to use this type of trust, because overseas jurisdictions, overseas problems, government changes, who knows what it could be. You just won't have those kinds of possible issues within this trust mechanism. The trust is effective, by the way, in over 100 and some countries. I mean, this is an international trust, by the way.
Awesome. And you mentioned also the protection of your property and assets that would protect you from all sorts of things, right? Like encroachment and invasion and intrusion. Talk about eminent domain, and then right after that, I guess we'll open it up to see if there's any questions. Talk to us a little bit about eminent domain and intrusion and encroachment, if you can.
There's been a lot of concern. In the things in the news that we're hearing nowadays is just very alarming, particularly when it comes to Agenda 21 and things like that. And so to have your property, it's a whole different topic, but I'll leave it with this. When you own property, bank accounts, real estate, or whatever, and unless you own a allodial title to your property, you only own the beneficial interest to that property. You don't own the legal interest. And so complications can come up because someone else has the legal interest in the property. And from case to case, there's been significant advantages to looking at this type of trust held in fee simple type of an ownership in a trust that's spendthrifted with a clause to protect the assets in there for the use of the beneficiaries at a later time. And the trustee, that's his duty under law. And so there's been various suggestions about how eminent domain could be blocked from obtaining property in a trust like this. And so I hesitate, to practice law with any kind of a statement like that, but it would give you a significant leg up in argument on how this may or may not be a protection item for eminent domain, but and for court orders of any kind. I mean, the asset protection, if you got teenage drivers and they hit a school bus on the way home and injure 19 children or something, it would be better to have your home and your other properties away from that type of encroachment. Not we're trying to avoid legal responsibility, but, let's just be smart about this and, let these guys and their attorneys and their enrolled agents review your situation and see if it can be helpful. The only thing I do is want to educate people on the value of it, and we've talked about that, and then we just take it from there, Sal. So